I think that you have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this? And why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy again.
It has been just before a recession. So I think this happened in 2001, 2007, right before the recession.
The U.S. Federal Reserve's recent decision to cut interest rates by 50 basis points for the first time in over 4 years has raised concerns about a potential recession in the world's largest economy. Historically, the Fed has implemented a 50 basis point cut only during significant economic downturns. The dot-com crisis in 2001, the global financial crisis in 2007, and the COVID-19 pandemic in 2020. These cuts have typically preceded severe economic declines, leading analysts to interpret the current rate reduction, despite official assurances of stability, as a warning signal of deeper issues within the U.S. economy. Since publicly announcing interest rate changes in 1994, the Fed has shifted from a neutral stance to a cutting stance on 6 occasions. It initiated shallower cutting cycles in 1995, 1998, and 2019, starting with a 25 basis point cut. In contrast, deeper cutting cycles began during more tumultuous periods, such as early 2001, 2007, and March 2020, always commencing with a 50 basis point reduction. This trend suggests that 50 basis point cuts are typically reserved for serious economic conditions. Billionaire investor Chamath Palihapitiya and venture capitalist David Sachs believe that the Federal Reserve's choice to initiate a 50 basis point cut rather than 25 basis points signals their expectation of challenging economic times ahead. They argue that the central bank attempts to project a sense of calm and normalcy in the markets to avert widespread panic. Palihapitiya and Sachs foresee additional rate cuts before the end of the year, and suggest that a full-scale monetary easing may occur if panic escalates in the coming year. Raoul Pal, founder of Real Vision, also forecasts additional rate cuts in 2025, even in a low-inflation context. He believes central banks globally are working together to keep rates low and provide liquidity to support asset prices, predicting that the Fed could cut the Fed funds rate by another 2.5% to 3% as inflation remains under control. Following the Fed's recent announcement, he tweeted, "All the hot takes on the Fed seem to forget that the real Fed funds rate is just way too high for the current economy and too high to service or erode the debt. Rates will go lower." If you want to stay updated and understand what the top Bitcoin and cryptocurrency investors and leading thought leaders of our time are thinking, don't forget to hit that subscribe button and turn on post notifications for more videos like this.
What's the more likely scenario, Chamath? Is this similar to the dot-com great financial crisis or similar to 2020?
Well, I think 2020, you have to put it a big asterisk because the question is what would have happened had there not been COVID and had there not been an entire global shutdown. So if you go back to that chart, you could probably just extrapolate and cut out that part that's flat, because the part that's flat from 2020 to 2022 was largely artificially created, because on top of that, we injected so much money into the economy. The reality is we probably would have raised at some rate of change that you could have predicted from 2016. So what do you take away from that? I think that you have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this? And why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy again. So the reason why markets tend to fall once the rate cut cycle starts is because the next couple of quarters sort of demonstrate what I think the Fed is expecting, which is that there's pressure in the economy. We have not seen that flow through in earnings or in how companies describe markets on the field, by and large, except for a few. So I think this part of the cycle now will be about all of these companies telling us whether there's nothing to see here or whether there is actual real pressure. And if there is real pressure, it'll probably look like the several times before where you're just going to have to contract the value of financial assets because they're just not worth as much when they're earning less.
Okay. Sachs, any thoughts here? Just balls and strikes?
Well, I think a lot of people are commenting on the fact that the only other two times where we've had a 50 basis point rate cut in modern history, it has been just before a recession. So I think this happened in 2001, 2007, right before the recession. And the Fed had to do a dramatic rate cut because they could see in the data that things were weakening. So a lot of people are asking the question, well, is that what's going on here? Now, Powell's comments, though, are indicating that the economy is in good shape. He said the economy is in very good shape, that basically indicating that they had tamed inflation and that they would look to cut another 50 basis points this year. So Powell's rhetoric is, in a way, at odds with the magnitude of this cut. So why didn't they just cut 25 basis points? I think people are trying to figure that out. If the economy is hot, why wouldn't you tiptoe into rate cuts and just do 25 now?
That's the key thing. If you look at the dot plot and if you look at where the smart financial actors are betting where rates end, so it's hard to sort of like look at any point in time, 50 now, 25 later. What does it all mean? It's very hard to know. But what is much clearer is where do we think terminal rates will be even in the next 18 months? And it is dramatically lower from where they are now. And I think that supports Sachs, that argument that you just made, which is if you're going to basically cut this aggressively over the next year to year and a half, by the estimates of very smart financial actors whose job it is to spend every day observing the Fed, then they must see something. Because otherwise, as you said, you could take a much more gradual approach.
Despite the Fed's decision to cut rates further, Raoul Pal is much more certain about the transformative impact of artificial intelligence and other disruptive technologies like robotics and energy storage. He predicts that these advancements will fundamentally reshape the world by 2030, marking the onset of what he calls an economic singularity. According to Pal, traditional economic frameworks will struggle to adapt to the rapid changes driven by AI, which he believes will surpass human intelligence across various fields. He argues AI is basically infinite human knowledge now. As these models scale, the breakthroughs come through, and the average IQ of AI goes from 100 to 400, and then on to 1,000,000 times the intelligence of a human. Pal is optimistic that this technological acceleration will address significant productivity and debt challenges, allowing society to manage these burdens more effectively. He anticipates that an AI-driven renaissance will commence in 2030, leading to profound global economic and market changes. He tweeted, "In the next 6 years, we will witness a radical shift in the global economy, driven by the rapid advancements in artificial intelligence, AI, robotics, and renewable energy. This period will fundamentally alter how we understand markets, businesses, and economic systems. As professionals, investors, and entrepreneurs, we must prepare for the seismic changes ahead."
What AI has done has changed everything because now knowledge, which was a scarce thing, like you pay for a lawyer, you pay for a doctor, you pay for an accountant, you pay for an expert, has now become infinite and basically free. It's a deflationary nuclear bomb. But what is AI? Well, it's a human mind, let's say. It's exchangeable for a human mind. A robot, exchangeable for a human body. Amazon already employs almost more robots than humans now, and that'll keep going. So what you've got is infinite humans. Now, so that's the population growth part of the equation. Holy fuck, we've just gone from slowing population growth to, oh my God, in a few years' time, it's going to go infinite. We can see the AI and the robots scaling to billions and billions and billions. If you listen to Elon Musk, all of these people, they're talking about, well, there'll be 1 billion humanoid robots by 2035 or 2040, whatever it's like people don't understand the impact, the economic impact of infinitely scaling human ability. Then the productivity side. So we're all more productive using AI and stuff like that, but that's not the big game changer to the conversation we were having before. If productivity is the amount of output you get per kilojoule of energy. So there's two factors there: is becoming more efficient, which is what technology does. But really, electricity prices have been pretty stable for a very long time. But if I'm right that electricity becomes abundant, it's going to collapse in price.
Mm-hmm.
So if technology falls, if electricity costs in 6-8 years' time fall by 50%, that's a 2x multiplier on productivity. If you then add in, because the equation is population plus productivity, if you add in the infinite population growth, now, obviously it doesn't go infinite immediately, but it's the rate of change, we're going to have la la land GDP. We can have GDP at some point in the 2030s, global GDP hitting 20% a year, 25% a year. Theoretically, it can go to 100% a year. Just depends how fast we scale the robots and the AI and how cheap we can make energy. Okay, what the fuck does that mean? Because the robots and the AI are making the money. Where did humanity fit in? What happens? And it was Beeple, the NFT artist, who raised just a fantastic question. He's like, Raoul, I'm just thinking this through. What happens if somebody gets AGI and then aims it at the stock market? Surely they just win the whole game. And of course. So in which case, if everybody's got AI, what is a stock market any longer? What is a company? What is a company anymore when AI can have AI agents and build their own? And they're using crypto payment rails to pay each other. What is a company? What is the life of a company when if you build some cool tech product, I just put it into my AI and say, copy this, and it writes the code in a minute or 30 seconds. We can already do a lot of that. I can give it a web design, say, hey, just do this, copy that. So how long do businesses last, startups?
Mm-hmm.
How does it become investable? How can we make money? So I've just said, listen, I don't know. That's an economic singularity beyond which we do not know. And nobody knows the answer. So I think we've got 6 years to make as much money as we possibly can. So then we can go into that period of uncertainty feeling secure.
The recent rate cuts from the Federal Reserve underscore the urgency for investors to turn their attention to cryptocurrencies. Raoul Pal asserts that we have approximately 6 years left to leverage emerging technologies before traditional economic and market structures experience significant transformation. He emphasizes the need to adapt and navigate these changes collectively, suggesting that investing in cryptocurrencies could be prudent, given their historical performance as the top asset class. We'd love to hear your thoughts on Raoul Pal's insights and the analyses from Chamath, Palihapitiya, and David Sachs in the comments section below. If you enjoyed this video, please give it a thumbs up, subscribe to our channel, and turn on post notifications for more content like this. You have to watch this next.